So the next model is capital asset pricing model, which is actually very interesting and a beautiful theory. But at CA intermediate level or CMA intermediate level or CS executive level, we are not expected to have this much of knowledge. And honestly speaking, the way how it is given in any of the study materials, you open any professional academy's study material, you cannot understand that. So rather, I will give you the easiest way to understand what is capital asset pricing model, okay, in a role play, in a story. So put the heading capital asset pricing model. Capital asset pricing model. This is also known as CAPM, not CPM, okay? CAPM. Okay, now look here. There is one investor. He has rupees 1 crore. He is going to State Bank of India to invest in FD. Okay, this pays, say for example, 6% per annum. So there is one investor who has 1 crore rupees. He wants to put money in State Bank of India in FD 6%. Or he wants to purchase Government of India bonds. Government of India is releasing some bonds, so he wants to purchase that bonds. Okay, if you purchase gold bonds, they will give you 2.75% assured return and then capital appreciation. Or if you buy any National Highway Authority of India bonds, NSS bonds, Kisan Vikas Patra, so many types of bonds are there which pay 7%, 6%, 8%, something like that. Now, there is one company X Limited. There is one company X Limited. Now the X Limited is asking you, dear investor, dear Mr. A, please invest that money in our company equity shares. Investment in equity shares of X Limited. Same 1 crore rupees. Now investor asked X Limited, okay, I will invest in your company equity shares. How much return will you give? So investor asked, how much return will you give? So investor asked the company, how much return you will give? Company said, you are ready for that 8%, no? When you are investing money in State Bank of India, you will get 8%, no? I'll also give you, 6%, I'll also give you that 6% only. Investor will kiss X Limited with left shoe. Investor will kiss X Limited with left shoe. Investor will ask simple question, do you think I'm an idiot? Do you think I'm an idiot? So he will tell you the fundamental principle of financial management. Investment, risk, return. So what is my first investment? State Bank of India fixed deposit. My risk is absolutely zero. My risk is absolutely zero. Why? Because interest is predetermined and safe. Principal amount is predetermined and safe. I know I get 6%. I know I will get at any cost my 1 crore rupees back will come to me. So neither my principal amount comes down nor my interest amount comes down. I know that this is 6 lakhs. I know that this is 6 lakhs. I know that this is 100 lakhs. I know that it is 106 lakhs at the end of 1 year. So my risk is zero. So if return is 6%, I am okay because this is risk free. I am not taking any risk. Zero risk. Zero risk means risk free. I don't have any risk. But when I invest in equity shares of X Limited, I am subject to market risk. I am subject to company risk. So stock market falls, company falls. If there is problem in the company, company falls. So there is some problem in the company. Company market price falls now. For example, Reliance Communications, 425 rupees issue price. Today 1 rupee, 50 paise, 40 paise. Company has a problem. Market risk is related to stock market. So which company will have what problem in future, I don't know. So we cannot imagine what will be the company risk that comes in future. That company might have got so many types of risks. But what about stock market ups and downs? So because of COVID, if I lose money, or because of COVID, if I make more money, or because some global cues. So yesterday, day before yesterday, today we are sitting on 24th September 2020. Yesterday stock market crashed. Day before yesterday stock market crashed. That day before stock market crashed. Why? Because they are saying in Europe lockdown 2.0 will be. In Europe, if lockdown 2.0 is there, why are we concerned? Because stock markets consider global cues, border tensions with China, stock market will fall. Something happened in North America, stock market will fall. Donald Trump won elections, stock market in India will fall, or will India, in India it will rise. Vaccine successful in Russia, Dr. Reddy's lab, 10%, 15% it has grown. If I invest money in equity shares of a company, there is market risk. So logically, risk is high, return should be high. I want more return. So what is this? I want more return. So my concept is simple. I want more return. So if you give 6% to me, I am not happy. If you give 6% to me, I am not happy. I want 6% plus more. I want 6% plus more. Okay, now the question is, why you want more? Why you want more? Because I am taking more risk. This is called risk premium. Because I am taking risk, give me risk premium. Now, capital asset pricing model will explain you how much more. If you say more, how much? How much do you want? 20 paise? 1 rupee? 2 rupees? 5 rupees? 10 rupees? 12 rupees? How do we calculate? Shareholder cannot negotiate with the company, no? So there should be one universal formula which works with the stock markets. You understand? Beautiful formula. Beautiful formula. Okay, now look here. How much more? See, first understand what is the risk of investing money in this company. Let me change the battery. Let me change the battery. One, what is the risk of investing money in X Limited? So what is the answer for this? Stock market variations. Market price of X Limited share variation. So stock market can crash, my company can outperform or my company can underperform. So what is the relation between stock market and my company share? This I want to calculate. What is the relation between stock market and my company share? Now, look here. I will give you a simple example, okay? This is stock market. Sensex. Okay, Sensex at the beginning of the year. Imagine Sensex at the beginning of the year. What happened to this? Started with say 25,000. I have one more battery, two more batteries. Oh my god, one new packet is also there. Okay, so beginning of the year, say Sensex started with 25,000. So this is on 2019. This is on 31/3/2020. So here stock market started with say 25,000. So increase, decrease. So finally closing is 27,500. So stock market started with 25,000 at the beginning of the year, ended with 27,500. So change in stock market. So do you remember in leverage analysis we have learned change is equal to closing minus opening divided by opening into 100, or you can say current year minus previous year divided by previous year into 100. So 27,500 minus 25,000 divided by 25,000 into 100. Can I say it is 10%? Last year 25,000, this year 27,500, 10% growth. There is 10% growth. Now take X limited share. Take X limited share. This X limited can be Reliance Industries, Infosys, you take any company, X limited share. Now imagine the same, graph we are preparing for X limited, okay? The same graph we are preparing for X limited. So imagine it started with 1,200. It started with 1,200. So it went up, came down, went up, came down, went up, came down, went up, came down, went up, came down. At the end of the year here, it stopped with 1,440. Now what is percentage change in X limited? So can I say it is 1,440 closing minus 1,200 opening divided by 1,200 opening into 100, this is equal to 20. Now the relationship between the stock market and X limited is calculated as percentage change in X limited share by percentage change in Sensex, Security Market Index, Sensex or Nifty, you can take any benchmark. That is equal to, can I say 20 divided by 10 is equal to 2 times. Pavan sir, what is this 2 times? This means if stock market falls by 1%, X limited fall by 1%. If stock market rises by 1%, X limited rises by 2%. Oh my god. So if change in stock market is 1, change in X limited will be 2. So stock market is up by 1%, this company will be up by 2%. That is the reason sometimes you see stock market is up by 1%, Reliance is up by 7%. You will get mental. Oh my god. At the same time, if stock market falls by 1%, Reliance can fall by 5%, 6% also. Who knows? This is called in financial management language beta. Now they will start the theory with beta is assessment or measurement of stock market systematic risk of X limited share, which is a correlation between the percentage change in security index with percentage change in X limited share. People will get mental. You will pluck your hair. I don't have hair. You will pluck your hair and say, Pavan sir, what they are writing, we are unable to understand. Everything, whatever the theory they have explained, I have given it in the explanation. So beta is 2 in the problem. Don't worry, the happy news, the good news for you is they will clearly tell you beta is equal to 2. Don't worry about it. Now beta is given. If beta is given, for beta 2 how much more I want? For beta 2 how much more I want? So stock market has given 10% in this year, no? Stock market has given 10% this year. This is known as return from stock market. So stock market has given 10. This is known as return from stock market. This is called RM. SBI is giving 6%, no? That has no risk. That is called RF, risk free. So SBI is giving without any risk 6. Stock market with risk it is giving 10. X Limited is having double risk than stock market. So how to understand this? How to understand this? If I invest in SBI, I'm okay with 6%. But if I invest in Sensex, I'm okay with 10%. But if I invest in X Limited, this is 2 times riskier than Sensex. That means if Sensex is 1, X Limited risk is 2. That is the reason Sensex beta is always 1. Security index, any index, Nifty, Sensex, S&P, you take anything, Nasdaq, you take any index, their beta is always 1. Stock market beta is always 1. So company beta, this is beta of stock market. This is beta of X Limited. X Limited is 2. So for in this situation, how much more I want? So Markowitz, Sharp, all these people, they have contributed extensively in this security market line, capital market lines and all, efficient market theory, portfolio management. You cannot understand all this stuff. So the easy thing is, they said KE is equal to RF plus beta into RM minus RF. This is the formula they have given. What is this? This is risk-free rate. This is risk. This is, I am taking more risk, I want risk premium. Now the good news is, in the question, RF will be given, beta will be given, RM minus RF will be given. Pavan sir, it has become LKG problem. Yes, exactly, it is LKG problem. But if you are using K is equal to RF plus beta into RM minus RF without knowing what is RF, what is beta, what is RM minus RF, as a professional student, it is not justified. That is the reason I have given the whole story. Some students will really enjoy and say, Pavan sir, this is such an awesome concept. Some students will say, why are we bothered of all these things? Give that 3 numbers, Pavan sir. I have one calculator. I'll calculate, and that bloody 4 marks if I get in the name of God, that is enough. So whoever you are, this is the theory. You understand? So RF will be given, beta will be given, RM minus RF will be given to you. That's it. So now let us go back to the study material and read this problem number 9. Calculate the cost of equity of HUL Limited whose risk-free rate equals to 10%. Beta equals to 1.75. Return on the market portfolio is 15. So what is risk-free rate? 10%. So from the question, risk-free rate is equal to 10%. Beta is equal to, what is the beta given in the question? 1.75. Beta is equal to 1.75. RM is also given in the question. What is RM? 15. Return from market portfolio is given 15. So KE is equal to, we'll write the formula because we want to get more marks. So write formula again. Every problem you have to write formula again. So 10 plus 1.75 into 15 minus 10. Oh my God, such a big calculation. 15 minus 10 into 1.75 is equal to 8.75 plus 10 is equal to 18.75. That's it. Now Chintu will get it out. Sare, will they give this in the exam? This is examination problem. This is given for 4 marks. Easy, no? Easy. But look at the concept, how beautiful the concept is and how easy the problems are. Okay, so this is problem number 9. Now, look at problem number 11. Look at problem number 11. This is calculation of cost of retained earnings. Now, we have discussed cost of equity, we have discussed cost of preference, we have discussed cost of debentures, cost of debt. Now, cost of retained earnings. For the time being, keep one thing in mind. Cost of retained earnings is equal to cost of equity. If there is a difference, I'll tell you. So, for now, what is your understanding? Cost of retained earnings is equal to cost of equity. So, go to 11th problem and try to solve it yourself. MNC Limited provides the following details. Risk-free rate 7%. Beta is equal to 1.2. RM minus RF is equal to 6. Already they have given RM minus RF. So, remember one thing here, okay? In the question, if they say return on market portfolio, that means they have given RM. If they have given market risk premium, if the word used is market risk premium, this is RM minus RF. That means already they calculated RM minus RF and then they have given. Again, if you subtract RF, 4 marks gone. So be careful in the question. Return from market portfolio or simply shortcut market return. If the word market return is used, it is RM. If the word market risk is used, it is RM minus RF. So now look at this and do the problem. So take 6 into, they have done that percentage, no? This is a mistake. Percentages they should not put. Student will get mental here. So if you do 1.2 into 6% plus 7%, what will you get? You will not get this. Percentage you should not put. So it is 7 plus 1.2 into 6. So 6 into 1.2 plus 7, that comes to 14.2, 4 marks. So this is capital asset pricing model.